So we usually wait till just after 11 to get started. Put on my screen, see if I can recognize anyone. Good morning. Good morning. Hi, Daria. Oh, Kyle said he just got kicked off. Oh, hey, Scott. Scott Dukes here. See Phil from U of C. Welcome. We'll just wait a few minutes. One of our panelists just got booted as well. Not sure why. Hello, Martin. We'll just wait for Kyle to come back in.
Bonjour, Liz. How are you doing?
I'm well. How are you?
Can't complain. How's the weather?
Good.
You guys in Toronto? Are you in Toronto?
We're in Calgary.
Calgary. I'm in
Where are you,
Montreal.
Martin? You're in Montreal.
Apparently, I came at the exact worst possible time. That figures. Yeah, it's all good. So.
Not sure. We will once we do kind of say hello and feel free to leave your cameras on. But once we get going, we'll just ask that everyone's on mute. Kyle, are you back yet? I've got too many faces up here.
No, I don't think he's back yet.
Righty. Zoom may be a little finicky this morning. It's the second person that's been kicked out, so bear with us. All right, well, I'm going to get going with our intro here in the essence of time. Good morning, everybody. Oh, I'm also going to turn off my notifications here. Just a moment. We keep these pretty casual. If you've been here before. Back to screen share. Okie dokie. Here we go. Can everybody see my screen? Perfect. I see a few thumbs up. Perfect. Good morning, everyone. Good afternoon for some of you joining us from out east. Thank you for tuning in. My name is Liz McCrae. I'm a co-founder of Village Wealth, and we are here today to talk about the lender's perspective on due diligence. And we have Brenda Slauko, Chaker Espinoza, and Kyle Kreppenhofer with us here today to talk about all the fun things about lending and what they see in due diligence in an acquisition. We run these sessions every month with guest panelists on a specific subject. So if you haven't been here before, please come again, and we hope you enjoy the conversation today. I'll jump in by explaining a little bit about Village Wealth and what we are doing. And we are on a mission to make acquisitions more accessible for the average person. We noticed that there's a bit of a problem in the acquisition space, so we decided that we would set out and try and make things a little bit more efficient. So we're witnessing the most significant transfer of business ownership in history right now, with over 75% of businesses looking to exit in the next 10 years. It's an estimated $30 trillion worth of business assets to be transferred across North America, and entrepreneurship through acquisition is on the rise. We've got more people who are looking to acquire businesses, change career paths, or maybe they've been serial entrepreneurs and they just want to do it again, and just take entrepreneurship from a different perspective than doing a startup. But the problem is that 67% of people who set out to buy a business for the first time are not successful. And this is for a number of reasons. The process is quite complex, and good businesses are hard to find. The industry tends to be siloed and for many reasons remains underground. So Village Wealth is on a mission to build an all-in-one acquisition management platform that provides business purchasers access to deal flow, financing, co-investment from other investment partners, and advisory support along the way. What we've developed so far is our marketplace. So Village Wealth's marketplace is fully functioning right now. It's a place and a hub for qualified business purchasers where both the buyers and sellers of small businesses can search for each other and make the first move. Both parties are accessible to each other. And it's currently used by business owners, brokers, and M&A firms across the country to find verified buyers. So if you're on the hunt for a business to buy, or you're a business owner who's looking to sell, please check it out. And connections can be made immediately. The team behind Village Wealth, we come from a background that has sales, marketing, technology development, and business brokerage. Robert Wynn is our CEO, myself, Liz, head of partnerships. Giselle is operations and client services. Josh Diaz, who's here with us today, is in charge of marketing. And then we have Luke, who is our head of product, and he makes all things buzz behind the scenes. So don't be shy if you see emails from us or anything you want to discuss with any of us in our respective spaces. Please don't be shy and reach out. Little bit of housekeeping today is feel free to introduce yourself in the chat. Let us know where you're coming from. If you're looking for a business to buy, let us know what you're looking for in the chat. We're going to start off with speaker introductions. While Brenda and Chaker go ahead here, I'm going to try and assist Kyle. He is having some trouble getting back in, so we'll troubleshoot that while you guys are doing your intros. Then we jump into discussion. So I have some questions to feed these guys over the next 35-40 minutes, and then we will reserve the last 10 minutes for some of your questions. So feel free to put them in the chat as we go. We will monitor the chat, and some of those questions that you pose maybe get answered throughout the session. And then so we'll look at the remaining questions closer to the end. If you are a member, perfect. Hi, Kyle, you're back.
Sort of. I'm on my phone.
Okay, that's okay. We'll manage. Our next event is for members only who are subscribing purchasers through Village Wealth. We host private roundtables where you get to ask your own questions to a subject matter expert who we bring in. And the next topic is adjustments to purchase price, and it's being held on June 29th. So if you're a member with us, please attend the roundtable. That's going to be an interesting and exciting session as well. So that being said, we'll jump into introductions, and Chaker, you've been nominated to go first, so I'm going to hand over the mic to you.
Thank you, Liz. I really appreciate it. It's a real pleasure to be present. My name is Chaker Espinoza. I'm a relationship manager in RBC Commercial Banking, mid-market. I deal with diversified segments, so any business except healthcare and agriculture. I've had about 10 years in experience in banking, corporate banking. And we've definitely seen a shift in lending dynamics, lots of acquisitions, lots of people buying businesses. So definitely a great topic to be chatting about today.
Thanks, Chaker. Brenda, what brings you to this space?
Well, you do, Liz. I'm Brenda Slauko. I'm with BDC. I'm in the group referred to as Growth and Transition Capital. So obviously our group focuses on companies that are growing and scaling, and transition is the other part, companies that are doing management buyouts or acquisitions. I specifically focus on supporting tech companies that are in the prairies as they are growing and scaling and doing acquisitions. But myself and my colleagues, we can also be generalists and help a lot of the buyers primarily help them on funding those acquisitions. Usually they're one-time or unique events. So we are there to also give them some advice and help them navigate something that can be pretty monumental in the business's journey. And I will add that I guess I have 27 years of banking experience at BDC. So both on the debt and the quasi-equity and equity side. So
seen a lot of transactions move across the table.
Yeah, and if anyone wants to know who they need to get a hold of at BDC, because we know we're sometimes a confusing organization, it's good to know me. I know a lot of people in the bank and a lot of our different departments and funds. So consider me your concierge service for anyone on this call. I offer that to you.
Perfect, thank you. Kyle.
Can you hear me?
Yes, loud and clear.
Perfect. Kyle Kreppenhofer, Ashdown Capital here in Calgary. So Ashdown is a broker, not unlike a mortgage broker, but think more than mortgages. So working capital, equipment, M&A financing. And the business model is pretty basic in that we are trying to simplify the financing process, both for the customer and the lender. And one of the ways in which we do that is we engage multiple lenders concurrently in order to drive a bit of competitive tension there.
Perfect, thank you. And you've come from a banking background before Ashdown as well in various institutions, right?
Debt is all I know, totally. So I've done I've done my share of the big bank thing for sure.
Wonderful. Well, we're going to jump right in, Kyle. I'm going to start with you. Aside from providing funds, what role does the lender play in an acquisition?
Truthfully, they're either a partner or an investor, depending on how you want to think about it. The balance, though, is that, I think some customers, because they tend to be the big old banks, like they approach lenders with a bit of a confrontational, adversarial mindset, and it's not super helpful because, again, the lender is going to be providing a lot of insight into, they're going to ask questions that maybe you didn't think to ask, and that's more relevant, particularly as you've done fewer and fewer transactions. Certainly, if you feel like the lender that you're working with is not a partner, then that might be a trigger to find a different lender.
Can you expand on that, Brenda, from your perspective of Kyle's note of the lender being the partner?
Yeah, definitely that's the stance BDC takes when we're working with our entrepreneurs. As I said, it's kind of a momentous occasion when you're looking at acquisitions, and it's very emotional for the seller, and there's emotion going on with employees. So we often are there kind of as an informal advisor, I would say, because we're not charging for those services. But because we have seen so many transactions, we get involved early on maybe helping them get a valuator if they have to go down that road. So recommending chartered business valuators to help. We don't require it, but sometimes it's necessary on some of the dynamics. And then we're also helping them with some of the structuring, getting them prepared for their letter of intent, different things we've seen on earnouts or vendor takebacks, because typically the sellers don't want to do a vendor take back. That's usually the starting point. And as a lender, as the partner, we have a fiduciary duty to say, yeah, we want to protect ourselves in this loan, but we're also trying to make sure that the company is set up for success after the transaction and it's not too weighted or leveraged with debt. So there's a lot of, like Kyle said, we ask a lot of questions, and sometimes the answers are known by the purchaser. Sometimes they're like, oh, I didn't think to ask, but I'll go back and get that information. So it's a lot upfront, just helping them with the letter of intent. As I said, it's a lot, and we haven't even hit the due diligence part. Once that LOI is actually signed, when you really start digging deep.
Yeah, and I want to come back to that later on in the conversation about, because it's my understanding that some of the banks want, the letter of intent before ahead of time when they come, or some lenders will want to be in more and help with the drafting of the letter of intent because there's weighing principles that they tie into. So we'll get into that later. But Chaker, and in from your position, yeah, what's the lender's role aside from just capital?
Liz, there's a lot of competition out there, and definitely building relationships is very important. And the dynamics between the client and the relationship and the advisor, the relationship pastor and the advisor is very, very important. It's what Kyle said. It's not every business that comes to RBC is going to fit within a risk scope. So there's definitely a due diligence process that we follow. We assess the relationship portion of it. I would say the relationship piece is going to be more than 50 to 60% of the whole picture when it comes to onboarding clients. But definitely it is an important aspect to look at. And we do sit and we spend hours assessing a situation, a business purchase. There is a lot of time that goes into the whole aspect of the purchase itself. We do a lot of advice and we do a lot of research in regards to how we would position our client to the seller as well. Here at RBC, we do have a team of people that work with myself and the client to draft the letter of intent, the purchase agreement. We review it. We give them our advice, and it's definitely a process that takes time and a lot of work.
Yeah, absolutely. So starting into what you guys are looking for in the financial due diligence, Kyle, I'll bounce back to you. What are you looking at in this process to start the evaluation?
Equity. I want some equity. Because one of the things that happens, and I think you notice it more so with first-time buyers, I think there are stories out there of getting deals done with no equity, or at least entirely on other people's money. And certainly in Canada, like the lenders you'll lose engagement from the lenders pretty quickly with that. So figuring out, and 10% is probably the minimum. I've heard of a story where BDC found their way into a 5% equity situation, but there were caveats. So it's an exception to the rule, right? The second item for me is definitely just a broad track record about the business. And that could be as simple as just looking at the prior years. How did this business perform? And you might have to normalize those numbers, right? Because if the prior owner has no debt, then you can't fault them for possibly stripping out a bunch of management fees that might kind of make the income statement look as though it's less profitable than it really will be going forward. And then the final thing is buyer expertise. And the more complicated the business, probably the more important that is. So a perfect example would be if somebody comes fresh out of school and tries to buy some oil field services business, let's say some downhole fluid management company, that's going to be a super difficult sell for at least a senior lender.
And how much weighting do you feel is put on the experience of the buyer?
Depending on where we are in the business cycle, it probably changes. But the complexity of the business, I don't know if you're going to force me to pick a number, it's somewhere in that 30 to 50% bracket, probably. That's highly opinionated, though.
Disclaimer, Kyle's opinion. Brenda, what about you as far as starting to dig in and look into what you guys are evaluating for the due diligence?
I think Kyle raises some great points because some of it is subjective and some of it's going to be really like, no, here's the numbers. But to your point, Kyle, like the management team, buyers' expertise or experience in the industry, not that lack thereof would mean you can't do the deal, but when you have like, I previously had this business, sold it, it was successful outcome, now I'm getting back into it. Obviously, that's way more of a green light, right? That's like, okay, we're checking boxes now versus, okay, if we're missing that, how strong now is the earnings? So in my mind, kind of banking, how I was taught 101 early days, there's this acronym MESSY, the management, the earnings, the security, and the investment. So Kyle hit right off the bat, the investment, the equity. So sometimes it's what are you bringing into the acquisition, but that can also be accomplished with the vendor take back, can be equity going into the transaction. Are you already in business? You have a business and you're acquiring another, so we can look at the equity that exists there. So you want to, again, you're trying to check off boxes. So there's the IE, the earnings part. Are you, because in the tech world, I'm not always dealing with cash flowing businesses. Sometimes they're in burn mode. But so you're going to rely more heavily maybe on the the investment side of it. But where there is earnings, where you have a stable cash flowing company, now you're looking at how stable is that earnings? What kind of financial reporting does the company have? In the banking world, we obviously higher rate review engagement financial statements over your compilation engagements, or what used to be called notice to readers. Those just don't have the same weight. And as a buyer, you should look at that too and see what kind of the financial documentation, that third party that's doing the validation, because that's predicating what your valuation is. It's on that financial part of it. So a lot goes into spending time looking at the earnings, the financial strength of the company that's being acquired. And then security, again, I'm in a group where we specialize in lack of security, but BDC, obviously we fund companies that are buying assets as well in acquisitions. So if you got a building, you got equipment, that's one thing, sure. But a lot of times we're in our group specializing in financing the intangibles. That goodwill portion is what's really being acquired there. So what are we doing around due diligence of that? Is that, again, becomes more subjective. So how long have the customers been around? Who are the customers? How diversified is the customer base? What's the vendor? Is he the end all and the only relationship with these customers, or has that kind of personal goodwill actually been passed along to the management team, and that's not what's there? So those I would say are the finance 101. Chaker can get involved and go how we go very deep into them, but I love the acronym, and I've had it for my whole 27 years. Is the MESSY. It's easy for me to just trigger and go, what am I, if you're missing one of those, then those other three components better be really strong. And that's what you're just trying to fill in the gap. Doesn't mean if you don't have them all, you can't do the deal. It just needs to be really heavily weighted in some of those other sections. So.
Yeah, it certainly doesn't sound like the acquisition lending is something that fits in a box, almost like more like the valuation, where it's part art, part science, and a combination all in between.
Yeah, definitely.
Chaker, over to you now too, and maybe you can speak to something a little bit more that Brenda pointed out, is the quality of the financials of the company that is being acquired. And maybe there's some people on the line here who may not be as familiar with those different types of financials. Can you elaborate?
Yes, definitely. Financials are very important. When it comes to intangible lending, lending with no real asset, it's a little different, and it's not straightforward. There's a lot of variables that we look at. For example, when we're looking at an acquisition and some, buying an existing business, we don't just look at one point in time. We look at historicals, and we look at how well has the company been performing in the past. We look at projections. We look at current year ends. So there's a lot of things that we look at prior to giving out the commitment to the client. When you look at a 3-year average, and let's say, for example, the business is doing really well this current year or presently, but they haven't really performed in the last 3 years, that could bring your ratios down, and it can affect the deal. And again, also, it's very hard to determine how much the lender is willing to lend at a specific point. So it can vary from 80% loan to value to 50% loan to value, depending on how strong the business is. So definitely things that we look at prior to putting what we call a discussion paper. A discussion paper is our commitment towards taking on an application. It's our commitment saying that we believe in the deal and we've done our due diligence process, and we would give a client a commitment that we would go ahead and submit it to risk. At this process, at this stage, I feel like we've done the sufficient background checks to make sure that we can take on the application to the next stage. But definitely the financials are very important. The projections are important. The historicals are very important, and the type of financials as well. Like if we're borrowing over $1 million, we're definitely looking at a review engagement. If we're looking at below that amount, then we're looking at less complicated financials. But understanding the financials, understanding the notes that come with the financials is key when reviewing the business and taking on a new business by the client. And definitely historicals, projections, in terms, very important documents to be looking at when presenting a file.
And what happens if the business owner who's selling doesn't have projections or doesn't have the review engagement level degree of financials? Because that happens quite often, right? Like, so what happens in those situations from your perspective?
Totally, it happens quite often. And when clients present files to us and it's a holistic file, it makes life easier both on the client and the relationship manager. There's a lot of times where we give advice onto what we would expect and what risk would require. But you're right. There's a lot of times where clients don't have projections, and sometimes they don't even have the ability to present historicals. We do work hand in hand with the buyers and the sellers when it comes to this situation. I'll just give you an example. We had a client come up to us, had historicals, but didn't have projections. And we've asked him to go to the seller to see if it's possible to produce projections, but a lot of times they don't want to go to that extent just because it might be costly, or they're not willing to go ahead and provide us that information. There's a lot of times that our client takes on that initiative and works with their accountant to see what projections would look like. It is very important, I feel, especially when you don't have historicals. Projections is definitely a pro when it comes to cash flow or cash flow term loan lending, when it specifically concentrates on intangible lending. When you have real assets and real hard security, it changes the whole dynamics, of course, and it changes the loan to value. But when we're just focusing on intangible lending, it becomes a little tougher. But it's possible.
I think it's building on what Kyle said, though, like how traditional is the business, how easy is it, how predictable is it? Then you're more set up to look at historical and go, okay, forecast, not so hard. But there are certain industries, certain businesses that can be seasonal. I'm going to think of tech, which is in high growth. Like projections are the necessary. And I think at some point you have to realize there are costs associated with doing acquisitions. If the review engagement statements aren't there, it's not just going to be Royal Bank that's asking for them. It would be BDC. It will be every bank. So that seller has to realize that's a cost they're going to have to bear. Sometimes they split it, purchaser and seller. We're looking at a transaction where the company is looking to acquire a division of another company. So there's no financial statements. So a quality of earnings report is going to be required. I mean, we'll, again, just like Chaker said, we'll work with the buyer and maybe to some extent the seller to keep the costs low, to keep the mandate tight. But that financial information is required. It is establishing our internal valuation of what that company is worth. And we're trying to see, are we aligned with what the purchase price is? Because if there is a discrepancy, then usually, as Kyle mentioned right off the bat, then it's going to be borne by equity investment or the vendor take back, because the banks will only get comfortable to whatever level we're going to be comfortable at. And usually it revolves around debt servicing, of course. And those projections, again, it's a big circular conversation, but it comes right back to that. And what can a debt service going forward?
Right. I'm going to lean in. That leads me to my next question about, and Kyle, I'll put this to you, is, how does purchasers coming, purchaser and seller have been engaged with each other. There's, an offer or a price that's been established between the two of them often by the time it comes to you guys. How do you guys look at that valuation or that purchase price when it's coming to you? It's already been kind of, hashed out, negotiated to some extent, and then it's coming to you guys. How do you guys look at that valuation, and how does that play into your,
like, how do we validate it, sort of thing?
Yeah, or if it's like you guys are seeing that it's way out to lunch, and your approach to that.
Yeah, so depending on the deal, like the bigger the deal, the more scrutiny there, in my experience, the more scrutiny that there tends to be on the purchase price. Smaller deals, like if you're saying, I don't know, pick a number, under $1 million, my experience had been that the enterprise value is just assumed to be the purchase price for the most part. The hard part is there's BDC kind of owns under $1 million because the banks have a hard time rationalizing enterprise value at all. The purchase, like the enterprise value of the business, it's a combination of your transaction EBITDA and your enterprise multiple, right? So your quality of earnings report can help rationalize the transaction EBITDA if it's a really hard case to make. So example, you're saying your transaction EBITDA is $5 million, but the company has never historically generated more than $2 million on a normalized basis. You're probably going to want to investigate a QE report to help make the case to the lenders, because obviously the buyer got comfortable with $5 million somehow, but the multiple is kind of the multiple to a certain degree, insofar as, and some of the banks have teams in the back office that say, this industry at this size should be 5 times multiple. And so that's more of a given number. And it's just a function of presenting the lender, if they don't have it internally, comparables to rationalize that number. Did that answer the question?
Yeah, it does. And I see Brenda and Chaker nodding here and trying to hold back their comments. So I'll let you guys jump in, Chaker, if you want to take it, or I can see Brenda is kind of on the edge of her seat.
Yeah, definitely. I mean, there's every business segment's going to present differently. We just had a deal that the business valuation was about $2.5 million. We were able to lend up to 1.8, 1.7, the 10-year AM at 80% loan to value. That's something like that. It's going to be very subjective. You know what I mean? It's every industry is going to present differently. It just depends on how strong the business is, how long have they been operating in, and we do have internal information that we use to assess the valuation of the business. It's definitely going to be definitely an important aspect. We look at that and see, well, does this make sense? Is it really worth that much? And is it comparable to other industries? Is it comparable to other files that we've underwritten and approved in the past? So a lot of times when we approve a kind of out of ordinary file, we use it as a benchmark and have that particular information present so that we can take a look at something similar in the future. But we've seen, some industries are going to be tougher to present. Some industries are going to be easier to present. But again, the quality of the financials, the quality of the business itself, how long have they been operating for, how strong they are in the current industry. Is it, comparable to the benchmarks that are out there? We've been very creative these days, especially because it's our economy is very different. There's a lot of acquisitions and there's a lot of transfer of wealth. And I feel in the last year and a half here at RBC, we've changed a lot of our internal mandates to be able to look at these more complex files and be able to get out of our comfort zone. So we've seen lots of good things happen when it comes to creative ways for financing intangible lending, and expanding our AM scope and also the loan to value scope. Because I would say 3 years ago, we would stop at 60% loan to value, maybe at 6 or 7 year AMs. Now we're seeing more files that, 10-year AMs, 80% loan to value, 10-year with 1 year of interest payments only. So definitely I would say the dynamics of the economy right now is playing a big part on how we're looking at business acquisitions.
Wow, certainly sounds like things have been shifting
Yeah.
in the last few years. Brenda, you had some
Yeah, I
thoughts
was
there.
nodding to what Kyle was saying a lot. Like, the banks are like, we're evolving. We are trying to take more risk, whatever that means for what risk is. But Kyle's absolutely right. Like, as an entrepreneur, as the buyer, if you can show you are the expert in this space and the company you're about to buy, you need to advocate for why did you agree on that purchase price? What was your thought process behind it? What due diligence did you do? What are the multiples or comparisons that you found that justify this? Because we know the buyer doesn't want to pay a stupid amount of money. That would not be in their best interest. But you need to share your research with us, because we are doing our own research. We're grabbing our own comparables, and we have that example going on right now with the transaction, and we have a national scope. I can ask my colleagues in Eastern Canada about a similar business. Like, it's not like your company is going to be the one-off, right? We can pull data from across our database, across our clients, and see, well, what are they trading at, or what multiples should I expect? And I tend to go back to our clients and go, so I'm seeing this. Why are you so much higher? Like, explain to me why you're justifying this premium. And then they can, because they have done their work. They know, oh, well, that's not really an apple, that's an orange, and that's a grapefruit you're comparing to. It's all fruit, Brenda, but it is not all apples. I think in the one case we're looking at, it's more like, no, that's a ambrosia apple, and that's a jazz, and that's a gala. Like, it's that close. They're all apples, but I don't know what's actually beneath the skin. But our entrepreneur does, and they're able to say, this is why our multiple is here and why we can justify it. So as that, if any expertise you can have and bring to the banks, like, we're willing to listen. We're not so steadfast and like we think we're the experts in your space. That's not where we're going to come from. So if you help us, then it helps us make the argument to our own credit department and take that risk on. But if you feel, like Kyle said right off the bat, you're not getting those kind of questions from your bank/partner, you're probably either not dealing with the right banker or maybe the right department in that bank that can really help and advocate for you, because that's what it comes down to in these transactions. You want the banker to be really curious about your business, ask lots of questions, challenging ones as well. I would also, it's occurred on a couple occasions where purchasers did look like they were paying too high in multiples, and how they were justifying it was more like, well, I see the potential once I acquire it, this is where I'm going to grow it. So that, it didn't sit well. It's like, why are you paying for all the work and effort you're going to put into this business? Why is the seller getting? I get, but they get, again, is that it's a very emotional thing. They get very excited. They see the potential. They want the transaction to happen at all costs. And that's where we kind of have to slow them down and go, okay, don't pay for your hard work, or start being smart about it. Put in an earn out. Like, what if those clients don't stick around? What if you can't actually get a bigger like cart out of that like that client? So you need to sometimes get them to be objective again. It's really hard. It's a very emotionally charged transaction. But I see Kyle's nodding his head too.
Yeah, I can see he's got opinions here too.
Yeah, we've all had this conversation.
And you bring some really good points to light. Like, and even Kyle, you mentioned it earlier on, when sometimes a purchaser comes in and has this confrontational opinion of the bank as not being a partner, but being a bit of a gatekeeper, and in a way that they are, but they're trying to protect the purchaser as well as their their capital, and see things that you don't necessarily see. But I love, Brenda, how you're saying, advocate. If this is what you're willing to pay, advocate for why, and advocate for the business that you're about to purchase, but you have to be able to defend it. Kyle, and I want to give you time to kind of respond to Brenda's comments here if you have any. Did you have anything to add?
No, I think she covered it all really well, to be honest with you. I'd just be repeating myself or repeating her.
Well, I want to leave some time for some audience questions here, so I'm going to jump to my last question actually, and about there being some red flags that would hinder a deal. Where would you guys give some examples of a red flag that would come up where it's not going to happen? Kyle, do you want to take that one first?
Sure. It's hard to pick one. Obviously, the pitfall of asking a lender anything is their answer is always going to be, it depends. So, but customer concentration is probably a big one on some of these transactions, right? And the rationale, so a couple rationales usually come to mind. Yeah, we've been doing business with this customer for 25 years, no issues. Totally, super fair. The other comment that comes up, and again, rarely are there take or pay contracts outside of an infrastructure deal. It'd be great if they were, but they're just not there. So sometimes what'll happen is somebody will say, no, we don't have MSA, we don't have contracts, but we do have MSAs. And an MSA is essentially, it's a heavily negotiated document, so it's worth something, but it's not a contract. It is terms of engagement for a future contract. So the problem is when somebody presents the fact that there's an MSA to a lender, it's not really the comfort they think it is. And so as an example of customer concentration gone wrong, like I was in this is like a syndicated deal, like $100 million deal. This customer had been doing business with this customer of theirs for 25 years. It was half the business. But again, the feeling was they've been doing the business together for so long, they're not going to go anywhere else. They couldn't possibly. So bank did the deal. And on year 26, the customer walked. And all of a sudden you had no business. And what do? Right? Like it's so difficult to replace a customer of that size overnight. It's impossible. So you end up in special loans. Like it's a very difficult problem. Yeah, maybe I'll stop there.
Well, that was great. Yeah, customer concentration, definitely something to dig into. Brenda?
I guess when I think of an example of a transaction I did, it was underestimating the vendor in the transaction. So we were told all along, like he travels all the time. He shows up once a month, maybe goes to lunches with some clients, and that it was easy to transfer the business over to the like new management. And we did our client calls and all that was great. And in that transaction, after it closed, it was back I think it was back like in 2006, 2007. Like it was a while ago when things were really hot in Calgary. It was hard to keep employees. People, so a transaction occurs, new management team comes into place. Some of them are known to the employees, but there's just not the same comfort level of the vendor that would show up once a month. And it gave them all the reason to walk. Employees started leaving left, right, and center. It was not for lack of business. There was more than enough customers. They couldn't get the work done though. So I remember when my leader asked me, oh, I bet you wish you'd never done that deal. Because I did go to special accounts. We recovered some, but wish you never done that deal. I said, no, what I wish is we had done a bigger vendor take back. The vendor take back wasn't large enough. He could walk away and he put enough money in his jeans to be happy and to keep traveling around the world like he had always been doing. But a bigger vendor take back, he might have come back a bit more often and make sure the employees are happy, smoothing whatever he was able to do That would have been the crux of that one, is what I learned. So don't underestimate the seller and their relationships. Like that sometimes vendors are pain in the ass. Don't get me wrong. I've seen those too, that we come in and after like 2 years, we come and refinance the vendor out of the deals because it's like, oh, this isn't working as well. But don't underestimate. Yeah, that personal goodwill there, like it's not transferable, but sometimes you want it to hang around a little bit longer. So
Yeah, and that's a whole session in itself around sussing out those things before closing, and the culture integration. Yeah, that's a whole topic in itself. So we'll have to expand on that another day. I want to leave Chaker enough time to answer the red flags, and before closing too. Red flags that can be noticed before closing. It's too late sometimes when they're noticed after.
Totally. It's an important aspect of the business. People dynamics is very important. We do have two platforms at RBC when we assess clients. One for the analytical and the financial performance piece. There's a whole big part when it comes to assessing the CEO, the CFO, the management team. We look at turnover. It just reminds me of an instance, and this was a learning experience for everybody here at the center. We took in a client on who was buying a big industrial manufacturing company. There was some tension between the CEO and the CFO, CEO being the new acquirer of the business, and not knowing enough information about the previous management team and the CFO. He had a lot of influence. So when you lose a key partner at the business who spent so many years establishing the business from when it was small to where it is today, it can have a trickling effect. And that person ended up quitting, and then there was a huge following that quit behind that individual as well. So that happening, it affected the performance of the business. It affected the ability to hire an individual to take on the role. And of course, finding talent these days is very tough. So definitely a huge aspect of the assessment piece when it comes to understanding people management and people just as a whole, the history. Sometimes these things we can't predict, but definitely I would say it's about 40 to 30% of our due diligence process is understanding the people dynamics and the organizational structure prior to commitment.
Mm-hmm. Yeah, and so much people, there's so much often the attention on the financials of the company and the revenue and earnings, but yeah, the people are the machine at the end of the day. So we have a couple questions here in the chat, and Scott, I see your question here. It's the juiciest one of the day always, so I've left it here. What is the range of interest rates you guys are currently seeing? It was bound to come up. So I don't know who wants to take that one first. Brenda, you're smiling.
No, I want Chaker to go first.
Well, again, it's very tough to tell the client what interest rate they will be getting off the bat. It really relates. So whenever we're talking about interest rates, we always say it's subject to the risk rating. And if we have a risk rating of 1 versus 3, for example, your interest rates are going to be way better. So the less riskier the file, the better the interest rates. But just to kind of give you a kind of like a blanket answer, we've seen rates right now anywhere between 5.8 to 7%. So that's kind of where we're
on the low end, on the 5.7 on the low end. And what would be on the high end that you guys are seeing?
7.3, 7.2 on a risky file right now. That's what I've been seeing. The 4 and 5 year fixed are a little cheaper compared to the 1, 2, and 3 year fixed rates. We're not seeing a lot of variable rates at all. We're not approving variable rates as much, I don't see. To cash flow a file, we're seeing a lot of commitment on a 2 and a 3 year fixed from risk, saying we're only going to take this file on if the client is willing to go on a 2 and 3 year. So there's a lot of kind of barriers right now. But yeah,
Yeah.
that's where I'm currently seeing rates.
Thanks for that. And Brenda, I know BDC has a different stance too, because there's some flexibility in terms of some other variables that the BDC throws in. So I'll let you speak to that.
Sure. I'll just maybe start with expanding on the risk rating. Like every bank has a system. Ours goes from 1 to like 4.5 or whatever. And when we're talking about that, it's like, so a lot of it is the cash flow. Has historically, how strong has the cash flow been? Can it afford the debt it's always had? Can it afford this new debt we're talking about? And leverage gets in there. Sometimes the NAICS code. So what is the business in? It plays into how long has the business been around? There's a lot of factors. Like Kyle said, client diversity is in that risk grid system, and the product, is it a commodity or is it something unique? So a lot of factors we look at that comes up with an algorithm that spits out this rating. And obviously when you're a 1, that means you have more than enough cash flow to fund this program. And I at BDC don't get to see a lot of the 1s because my colleagues at the other banks, not my competitors, they're my comrades. We all do this together. We work together. They'll often do those deals because they're so strong and they cash flow. Not that we don't do those transactions, but they're going to be really good at it and very cheap. So when it comes to BDC, you're coming to us because we're going to offer some more flexibility. Maybe we will be a little bit higher leverage. So you can put little less equity down, or maybe the vendor take back isn't as rich as we'd like it to be, or maybe the vendor needs more repayment than, again, a traditional bank likes to see it very patient. So we have to work with those nuances. And then we typically keep with the longer term. We're not going to shorten it. And I'm mean this in all respect, RBC, we're not going to shorten it to like stifle the company's growth, right? We want to keep it long. So we just have a different risk parameter on how we look at it. So our pricing though, when you don't have assets. So again, being very clear, if you have a building, if you have equipment, you keep it down to like, we're trying the 5% and you're cash flowing. On my extreme, I'll get the extreme when I'm dealing with tech companies, there's no assets, they're burning money. You've got to see mid-teen type pricing. That's where we are. Whether they don't pay it all now, usually there's some kind of bonus or return structure that you get it later on an exit, but it's pseudo to equity. So you put yourself in, your alternative is raising equity and diluting. So you think of yourself on that kind of spectrum, but that is in the world of intangibles where you're not necessarily cash flowing in a perfect world. So just wanted to put it out there because some people will hear no from the bank. They'll just say, no, you can't do that transaction with that structure and it won't work. We're at BDC, we really put on our thinking caps. We work with the Royal Bank. I'm like, what if you do this and we get the vendor to do that and maybe we can do this? So it's also not a binary decision. We work with all the banks. So that's sometimes how you have to do it to get to the end solution.
Yeah, and that's a perfect segue to Kyle too. And I've seen that happen too, Brenda, where someone goes to one institution and gets a no and then goes, okay,
I'm done.
Well, I'm done. And I'm done. And the deal doesn't go forward because they don't keep digging and they don't shop around or go to the other banks and stuff. So Kyle, you see a lot of activity in the space. And we also have a question here on amortization length from Mark. And one more question after Mark. So Mark's asking about amortization length here. So if you can weave that into your answer here of what you're seeing across the board.
Sure. Do you remember how I said a lender's always going to say it depends?
Mm-hmm, mm-hmm.
This same thing applies with rates, obviously, too. So I think if you're gonna make me tell you a number, like from banks,
range, general sense.
Yeah, 5 to 7% for the banks that you're thinking about, like a traditional lender. But like I'm working on a restructuring deal right now, a restructuring of an acquisition financing. Well, that's like 15% money. So I mean, it depends on who you're in front of. Ultimately, credit unions who aren't really super great at cash flow lending, typically, they're like 8% money. So it's all over the map. And to Brenda's point, it's model driven. So it's so hard for us to answer these questions for your particular business before we actually put anything into the model, right? It's a tough question,
Well,
but it's the most common one.
I know. So, and everyone wants to know too, and it's hard because then there's a lot of acquirers who assume that buying a business and is like buying a home and getting a mortgage and going and getting pre-approved, but it's hard. It's hard for a business to give any, or a bank to give any inclination as to the lend without seeing that deal. So
Don't put 5% in your model is all I can say. Don't pick the low end. Go pick a high end and see if it still makes sense to you. Because where interest rates are rising, like, do not pick the low end. 5% money to me is kind of gone for an intangible type of acquisition. Like that's not you're not going to be unless you're amazing and pristine and have like also money in your own pockets that you're putting in. Don't put yourself in that low bracket.
Yeah.
be prepared. Be prepared. Get all the answers.
And amortization, I mean, like Chaker said, it's going up to 10 years. Like it used to be 5 was the max, and 7, 8, like BDC, we kind of do 8, but we also do balloon facilities. So, I mean, you can have a facility, you don't pay any principal back until boom, this date comes and maybe it's time with an exit or you get gobbled up by one of your competitors, who knows. But like, there's so much flexibility when you think about how you structure this. Banks have gotten more creative to some degree when it warrants. We can do it. It's a very competitive market, so we know we have to be creative.
Yep. And don't just take no for an answer from.
No.
Dig around. Okay, we have one other question here that I don't want to overlook from Brian. How do you evaluate the buyer when it's a corporation purchasing another business instead of an individual purchasing a business? Brenda, do you want to?
Sure. I mean, BDC, we have an internal valuation tool we use. So we'll use that to value the existing business. So say the one you own, and we'll use it to value the company you're about to buy. And then you smush them together and go, that's the total value at the end of the day. And that's how sometimes you could do 100% acquisition because your company is worth so much that it's kind of like rolling your equity into that business. That's potentially how it can be done. Yeah.
So in some situations,
we're going to take both companies, obviously, as guarantors to the loan. So.
Right. So in that situation, does company, acquiring company, if their value is so high, then they may not have to put cash down because it'll just roll them together.
It's the potential is there. Because I mean, an ideal situation that like RBC or any of us would look at is if your existing business is so strong that you could buy that business all on your own, or with our debt, you could easily pay it, and that company wouldn't even have to do a dime. Like it could be a total failure. Then that's easy. That's the 5% money. It's when your company is strong, it can afford some debt. It obviously needs the target company's earnings as well. Okay, and then we're doing all that due diligence around how strong that is. And if it's not strong, because again, maybe you're buying something that's not doing well. I don't want to talk about Kyle and his turnarounds, but sometimes people do want to buy those and show their improvement. Then you really get more into justifying the price, the valuation, and the repayment. But that typically it's how you're done. You're looking at both entities and the strength of them together, not synergistic values, like what are they worth individually to get, but then throwing them together today.
Together. Yeah. Well, we're 2 minutes to the hour. Chaker and Kyle, do you have any last comments to add to Brenda's on any topic that we touched today? Any last thoughts?
There is, just a quick touch point. I think, we've been talking about various, options and various ways that we look at a business acquisition. But if anyone has any questions, by all means, I mean, every business is looked at a microscope. Like we can't just use one example and then copy paste it to a second example. So we could definitely answer questions, particularly on a certain business segment, and give the individual a detailed approach on how the bank would take a look at it.
Thanks, Chaker. Kyle, any parting words? Talk
to multiple lenders. And I don't say that as a broker that has a ton of bias and talking to multiple lenders, but like it's so important to find the fit because you're going to be dealing a lot with these people, not just during the transaction, right? You're going to be living with these people post close as well, and personalities, they need to jive. So certainly the personality aspect is important, but also just finding that partner who's not. Some lenders, they have a tendency to be really good at finding problems, not super good at finding solutions. And so you want to find a problem solver, not a problem finder, I guess.
That's a great ending note. Find a banker who's going to look for solutions. Thank you guys so much. I really appreciate your time, and I know everyone was really excited for this topic today. So you can find each Chaker, Brenda, or Kyle on LinkedIn if you have further questions for them. This session will be posted to our blog section with Village Wealth, so it will be there if you want to reflect back on it. But everyone else, enjoy your afternoons, and thank you for spending the hour with us.
Thank
Cool.
you.
Thank you, Liz. Thank you, everybody.
Take care.